I've seen just about every major band live, except for like Jimi Hendrix and people who passed away before my time.
Well, that was a guy by the name of Richie Castellano. And this past Thursday, we did a private concert, and that was the recording
That's
for a bunch
fantastic.
of our customers. And he was wonderful, and he's a brilliant musician. He plays right now with Blue Oyster Cult. He's in their band now and tours
Yeah.
with them when they tour. And he's just been always, he was really terrific, and he plays, brilliant musician. So tonight, guys, I've done a couple of things to help us out in our endeavors. So a couple of quick things. One is that I am streaming this live to my YouTube channel, and it will automatically be saved. So then I will post a link on Canvas. If you wanted to go back and watch this session again, you can, and I'll be doing that for all of our other sessions as well. In the chat box is the link. I've also emailed everyone the link in case they get knocked off tonight and can't sign back in for any reason. Just go to the YouTube channel link that I emailed you, and you can watch our video live, maybe a few second delay tonight. And I wanted to do that just as a backup. I found out, or what I didn't find out is why people got kicked off, but I do believe, I kind of know why, is that FAU has set a default that if students are late, they can't sign in. I guess there's a lot of late people. But if you fall off and have already been on, I don't see why you shouldn't be able to log back in. But anyway, in case you do, right up here in the chat, if you'll look, it'll see the YouTube link. If you want to just quickly cut and paste that into a notepad or on your screen somewhere, you can certainly do that. In case you get knocked off, you can just click on that link, and you can watch watch our presentation this evening. So pretty cool. All right, so last week we went through a lot of topics, and most of it was surrounding how to make gifts, and then the use of trusts, and how trusts receive gifts, like the crummy powers of trust and the 5x5 powers of trust. And we only got up to this section in the slides, which I'll turn on in a second, where we're going to start to talk about some additional things. And I do want to go back over the use of the grantor retained annuity trust. I did it last night for a little makeup session for some people, but I want to go back over the use of the grantor retained annuity trust in a second. So, framing it holistically so far, we've learned a lot. We've learned about how people title their property. We learned that titling indicates, though a lot of times titling, whether it's by operation of law or in trust or something, really is done to facilitate the transfer of that asset at a later date. Whether that's to facilitate the easy transfer of the asset for yourself personally, like you own it personally, you want to sell it or something, or to facilitate that transfer to your kids. We learned a lot about annual exclusion gifts and a lifetime $11,580,000 exemption, and that you can use that at death as well. And so we're moving towards where we understand what a client owns. That's really what it's all about. Understand what they own, understand where they want that money to go eventually, understand what the drag on that money is going to be because of gift tax or income tax or the state tax, and give the clients a roadmap to transfer their assets either while they're alive or after they're gone, to ultimately go and get transferred with the least amount of tax drag that we can possibly put on those assets. Of course, there's other considerations when we do, advise clients about transferring assets, and probably the largest consideration, and we always go back to it, is control. A lot of clients, doesn't matter how much money they have and how much they can afford to transfer to their children without impacting their lifestyle, those clients are control freaks and may not want to make these transfers. So in dealing with clients and doing estate planning, sometimes we have to kind of walk that tightrope and of making sure that we're trying to mitigate tax liability and make things easier to transfer than more difficult to transfer, and at the same time balance the client's needs for control. I mean, listen, I'm not going to tell a multimillionaire client that just because there's a state tax, you have to go and give your assets away to your kids. I'm going to tell that multi-million-dollar client that one of the most effective transfer mechanisms is a gifting program designed to use your annual exclusions and or some of your exemptions if you so desire. And that's your choice. It really is your choice as a client. So you could, let me see if there's anybody in a waiting room at all. Hold on a second. Okay, we got people coming in.
Well, they missed a great class last night. John Moran set up an irrevocable trust for all of us in class, which
There
is
you go.
awesome.
That was great. So welcome, guys. I'll let me just make sure everybody's here. Please, again, try and show up a little early so it's easier for me to let you all in. Let's see here. Good. Okay. So I was just doing a little intro, and we're gonna go back now, and we're going to start looking at some of these other techniques. Let me just make sure I've got everybody on the roll call list. 1 second. We've got Damien. We've got Nick. I think I got a full house. Beautiful. Excellent. All right, I can get out of that now. Okay, guys, so let me share my screen and we'll take a look at a few of these concepts. So as last week, if I look at the slides just for a second, last week we talked about the B trust, irrevocable trust, intentionally defective, lots of different types of trusts. And now I'm going to give you some techniques to use to transfer assets that may have some gifts involved, but may not have some gifts involved. They are just other techniques to transfer assets over a period of time to reduce your estate. And let me go ahead quickly, and we're going to take a look at some of these techniques. Let's go here. So you should all be able to just give me a thumbs up if you can see the number cruncher screen. Okay, great. So I'm just going to go quickly back to we'll start with the simplest of all, which is an installment sale. Okay, let me make this a little bit bigger for my purposes as well as yours. All right. So an installment sale is just like if you bought a car, you'd buy it on an installment note. If you're selling a building, you could sell it on an installment note. But imagine, why would we even care about this in the framework of estate planning? Because a lot of times these installment sales are not done to outside parties, but they're done with your children or a close relative or even a business partner. And one of the reasons why we look at installment sales as a way to transfer an asset is because it is a way to defer until the installment sale is complete capital gains recognition, as well as some interest income, perhaps. So mostly capital gains. So if I had $1 million piece of property here that I had, $500,000 in basis, there's no place for me to put basis in here right now, but I'm going to sell this property to my kid over a 10-year period. And, the IRS, if I just quickly, while I'm here, go to this quick little browser here. Let me open that up. If it works. There we go. All right, so if I go to AFR rates, all right, guys, so the IRS publishes interest rates, and all of these techniques that we're using we have to use a valid interest rate. If we use an interest rate in any transaction that is below whatever the IRS published rates are, the difference between the interest we charge and the public rate is a gift to whoever we're doing the deal with, or let's in this case to our kids. So if I come over here and I look at the October 2020 rates, applicable federal rates, I click on that and we'll open it up. So every lawyer you know goes and does this every month to check their rates if they're doing any type of transactions for their clients. So let me scroll down here. So our table, I apologize, I went too fast. Let's go back up here. When I'm using Windows, it's not the greatest. So for example, we can look at these rates. These are short-term, midterm, and long-term rates that we have to use. I mentioned it in class, so the October rate, short-term rate, is 0.14%. This is for short-term notes, like a year-long note or something. And then you can see they give you 110, 120, 130% of that rate. Midterm rates are 0.38%, on an annualized basis. And look at this, long-term rates, which are rates greater than a year up to 9 years, or we can use long-term rates, 10 years, are only 1.12%. So this is the minimum amount of interest that I can charge anybody if I'm going to be doing some type of transaction. All right, so in this instance, I could assume that I can charge my kid 1.14% for the next 10 years interest on me selling my business to my son. And that's pretty cool. Now, my kid, at the end of the day, I don't know if he's going to be in a 35% bracket. Let's assume he's in, 28 or something. He bought my business. Maybe he'll be pushed into a 35% bracket. And he took the money he's been saving and he gave me, we called it $100,000 down payment, right? So in year one, my kid gives me $100,000 down payment, and he has to give me 1/10 of the remaining principal, which is $900,000. So he's got to give me $90,000. So in year one, he's got to give me $190,000. Now, the interest that he owes me at 1.14% on the balance of this note of approximately $900,000 is $10,260. Not so bad. So the very first year, he's going to pay me $200,260. So that's not a problem. That's fine. The business has to earn $274,000 that year, maybe. I mean, I could take that $100,000 note out of it. I mean, the down payment that he probably had in cash somewhere. But generally, the business would have to earn that much, pay taxes in 28% bracket to net $200,260 to pay the son off, to pay the debt, pay me off. Otherwise, I could be 134, is what the business really has to net to be able to debt service gross income to debt service this note at the end of the day. Why do I want to note? Well, the first thing I want to note for is the fact I have a couple of benefits to me. Benefit number one is the note value is what's in my estate, not the business's value anymore. All right? So I have accepted a fixed interest note that will not grow. This note will not grow to sell a business that if my son does a good job, will grow and appreciate substantially over time. That's number one. So I've accepted I've frozen the value. It's called an estate freeze, and I've gotten this in my name, or I've gotten this note back. The second thing is, let's say I told you before my basis was $500,000 in this business. So that means I'm going to have to take $500,000 and divide it by 10 years. Well, at first, I'm getting in $190,000. So I am, that $100,000 down payment is going to offset my basis a little bit. But every year, I'm going to realize when I get this combined payment, some of that money is going to be ordinary interest income, or ordinary income for the interest payment. In this case, $2,000, $3,000, $5,000. And some of this number is going to be about, maybe whatever percentage of it is going to be a return of, it's going to be capital gains recognition for me on the capital gains of the business. So installment notes work well because I can spread out my cap gains. I don't have to, and if it's a friendly sale to my kid, what do I care if I'm getting the money in over time if I've already got other dollars from my retirement plan and so forth, and the business was whatever. So this could be very, very useful tool to provide a good payment to the business. Then a good way to transfer a closely held family business. Quickly, if you look up here, and we saw the next one is SKIN, self-canceling installment note. Well, imagine if I had, well, I'm not going to talk about myself anymore because now I'm going to talk about people dropping dead. But let's say we had a client who had well, let's make it a little bigger because we're not going to do a self-canceling installment note on $1 million piece of property, because it would cost us too much in legal fees. Let's say it's $10 million. All right, so I have is that right? 1, 2, 3, 1, 2, 3. Okay, so I have a $10 million piece of property, and I have a client with a $10 million piece of property, and my client's 80 years old. And my client wants to sell this piece of property to his kid for a note, an installment sale, just like before. All right. So the interest rate right now, well, actually, the discount rate is 1.14% on these notes. We know that because we just looked at the table. And let's say the cost basis in this case is, we'll use $5 million as the cost basis, and the initial down payment is going to be $500,000. All right, and we'll just make the term of the note for consistency 10 years. All right, and let's just make it complete here. Payment period, annual payments. We're not going to do any balloons. And let's say the no risk market interest rate is 1.14. Okay, total interest rate 7.6. Okay, so what we do here is we're going to do the same sale, but we're going to add insurance on the sale. And the IRS gives us calculations to add insurance to the sale. What do I mean by that? We're going to add this thing called the self-canceling feature. And you have to buy that. The buyer of the property has to buy the self-canceling feature from the seller. So there's two ways to buy that feature, and that number one is to pay extra principal for that feature, and the second way is just to pay extra interest for that feature. So in this case, the calculation that the IRS makes us do on an 80-year-old, because it's based upon an actuarial table as well, is that we're going to have to pay $3.76 million more, 37% more in principal. So we'll pay $13,766. Now, that's not a bad deal, because if I'm, Dad's 80, he may not make it 10 years. So even if it's a price of $13,766 at 1.14% interest, what's really is the son going to pay or the daughter going to pay in extra dollars versus just buying it for $10 million but having to pay a premium interest of another 7.46% that the IRS calculates based upon mortality tables to buy the property. So what happens? 3 years into this, Dad dies. No more payments are due Dad's estate. The kid gets to keep the property for whatever it was worth. Okay, whatever's left. So if we look at the schedule, we just keep going down a little here. So you can see that this would be my total interest rate would be here plus my premium on principal. So my total annual payments don't really vary that much. The total interest to be paid on this deal is $767,000 because I'm using 1.14% on that amount. The total capital gain, if the transaction works, is $8.7 million for Dad. The total capital gain, if it was just on interest, would be half because of the $3.7 million extra fee that we're taking in. So we have a larger capital gain. The question is, what would happen, if somebody died in the middle of it? I think for the son, paying the same amount of dollars but having a chance to pay a lot less interest may be worthwhile. But again, why do we do these types of self-canceling installment notes? We do these because we do not believe, even though the parent or the person we're buying this from may not be terminally ill. In fact, we cannot do this if we have knowledge that they're going to pass away in a year, or somewhere around there. Well, we have to enter this with an attitude or an understanding that the client's probably going to live a normal life expectancy, but maybe not. So this is a great way to end the note and transfer the property by paying a little extra up front. Now, we talk about another way to do this is a thing called a private annuity, right? Let's go to that one. So in this case, we'll use that same $10 million. Now listen, you guys know when you go to transact and person can go buy an annuity from an insurance company. Not a problem, right? It's easy enough, no big deal. And you put it up, whatever you're going to put up, and and at the end of the day, the annuity company gives you back an income stream based upon, if you're going to do, let's say, a life-only annuity, based upon your life expectancy. Not a problem, right? In this case, it's very similar. Again, the 75/20 rate, we're going to use the long-term rate of 1.14%. And we'll come up with a client basis again of 500. And we'll leave the payments at a fixed rate here. And we're not going to defer these payments. We're going to start them immediately, but we could defer them. And we have a 65-year-old. Let's make it a little older. Let's make Dad 80 again. All right.
Does the 3-year rule apply to all these?
No, that only applies to life insurance.
Okay.
Okay, so we're going to, the IRS thinks 7.8 years is an appropriate life expectancy, which is pretty right on target, 87. And they're going to make us pay $1,281,361 back to Dad every single year, and we have to pay this. So the son in this case, or the children, become the insurance company, and Dad is the annuitant. He's just using these life expectancy calculations that the IRS makes us use to calculate the annuity payment back to the father. So Over 9.5 year life expectancy, we expect this 1 million, the annuity factor, 7.8. So we expect 1,281,000 a year being paid out. Now, could a $10 million asset achieve 1,281,361.32? You got to remember that when we do normal annuities, there's some principal that comes back. So the question, we'd want the kids to probably, if it's a illiquid asset, they're going to have to come up with this in cash. So there could be some cash flow issues. The tax-free portion, because we have an exclusion ratio, if you remember back to the insurance class, the tax-free portion of this is $55,555, which is his $9.5 million, I said, divided by whatever the life expectancy is. The capital gain portion of this is $1,055,000, and the ordinary income, the interest portion, is $170,000. What happens to a single premium immediate annuity if somebody dies prematurely? It ends, right? Same thing here. So just like a self-canceling installment note, this has an element of that risk built in, that if the longevity is higher, the kids still have to make these payments to dad. They don't end. If the so that's a potential issue here. By the way, the IRS is, and again, you don't do these unless you have some inkling that the client may or may not survive a normal life expectancy. Otherwise, it's probably a bad deal. The IRS is not the friendliest to skins and or private annuities. There have been a lot of abuses. So they will look out. If you end up getting into one of these transactions, you have to be a little bit careful. I did one in my entire career, private annuity, back maybe 17 years ago, I got to think. And I backed it up with life insurance to cover additional estate taxes. And it was a daughter and their parents, right? And it was real estate in Coral Gables. And mom and dad both died within 3.5 years. So it was a win-win-win-win-win-win-win. The attorney back all those years ago charged, I think it was almost $30,000 for all the planning and to set up the private annuity. It was, I guess there was a lot of liability risk built into that as well. Okay. Intrafamily loan, bargain sale, sale leaseback, and intentionally defective grantor trust. Let me just shrink this and we'll start talking about those items. Okay, we don't need to talk about this. All right, here's a good slide though, slide 49. If you want to look at the features of a skin private annuity, feel free to take a look at that slide.
All right.
Okay.
I'm not sure.
All right. Now, here's another great slide that starts to kind of tell us if we look at our objective versus what the technique is. So if the objective is to receive the entire purchase at the time of sale, we're going to sell it outright, right? Or we're going to do a bargain sale or a sale leaseback. So a bargain sale, to be clear, is a below market sale. So if my property was worth $1 million, fair market value, but I sold it to my son for $500,000, the IRS says that the $500,000 difference has to be accounted for as a gift to my kid. So either I'm going to have to, it's a taxable gift most likely because it's over $15,000, $16,000. That taxable gift, therefore it's going to have a gift tax return and I'm going to have to apply my lifetime exemption. But that's fine. People do that all the time, and maybe the difference is the kids pay the different, pay the other part. A sale leaseback is an interesting technique. A lot of people use it. Again, it's all these are sort of freezing techniques because the notes are frozen. But so if I own, let's say I own a car dealership, and many car dealerships have, the way they set up their businesses is Corporation A owns the land and Corporation B owns the dealership, right? And what happens is the dealership leases the land and the building and the land, I should say. The dealership corporation leases the building / land from the other company. So that's pretty normal. So why, if I'm a car dealer, why can't I just, what's the most valuable thing I have? Is it the dealership or the land? I would guess the building and the land, because the dealership, I could go get another dealership if I needed to with another brand and rebrand and put a new sign up and still sell cars. The service bay is pretty valuable, but it's a car. It doesn't matter what brand it is really. It goes up on a lift, and it just depends on who the mechanic is working on it. So why wouldn't I sell the land and the building to my kids? And I could take back a note if I wanted to. I could do a bargain sale, but I still need to use the property. So now my business is going to lease it back from my kids. So instead of me leasing it from my own company, I'm going to lease it back from my children, which is incredible because now the value will appreciate in my children's names. I could have a trust. I could sell that land to a trust and take back a note, an intentionally defective grantor trust, and have for the benefit of my kids too. So there's a lot of little techniques that we can use, and we'll talk about the intentionally defective grantor trust shortly. So now if I want to do an installment report, I got the installment sale, self-canceling installment note, and I could do a sale leaseback in installments if I wanted to. If I want to include the unpaid purchase price in my gross estate, if outstanding at death, right, then that's an installment sale. What does that mean? Whatever the balance due is going to be in my estate. That's all. Private annuity payments are interesting. So the only thing that's included in the gross estate in a life-only private annuity is the present value of the future payments between that point in time and for the survivor, the present value of future payments for the survivor. So just remember annuities. If you have a single life annuity and it ends, there's no value. There's a single life annuity, somebody dies, there's zero value to be included in the estate because there's no more obligation to pay. If you have a joint and survivor life annuity, what's included in the gross estate, whether it's in one of these plans, private or commercial, if Mr. and Mrs. Jones had a joint life annuity, like a pension, right? And it was a 50-50 pension, Mr. Jones died, whatever the present value of the annuity is for Mrs. Jones for her life expectancy is included in Mr. Jones' estate. So we have to do a present value calculation. That's a great test question. When is the value of an annuity, of an immediate annuity, includable in the gross estate of a decedent? Only when it's a joint life annuity and there's payments that can continue on to a secondary party will you include the present value of those future payments. Not bad. It's a good question. All right. So we can do private annuities and sale leasebacks. Allow continued use of the sold assets. It's just sale leaseback because you're leasing it back and you can still use the stuff. And if you don't want any gifts, right? Sale techniques, unless between related parties and purchase price do not equal fair market value, we have a bargain sale. They can't be related parties if you're going to do a bargain sale. But who's going to do a bargain sale and sell your stuff at a loss? I mean, unless you're really desperate and you have to. Okay. Which of these techniques would allow for the entire purchase price to be received at the time of sale? Installment, bargain, self-canceling installment note, or charitable lead trust? Well, I would say it's going to be the bargain sale because you're just reducing the price, but you're getting it all up front. Okay? All right. Real quickly, let me just go ahead and I want to stop this share And I want to go over a couple of quick concepts here. Let me go to whiteboard. And okay. Bring your shared window to front. Second here. Okay, can everyone just give me a hand? Can you see the whiteboard? Okay, good. All right. So I just want to go over a couple of quick concepts. One is I'd like to just go back over the AB trust thing, but I also would like to first go talk about self-canceling, not self-canceling, but intentionally defective grantor trusts. All these techniques we just looked at, we could have a trust shoved in the middle of it. Like if I wanted to sell a piece of property to my kids, I could just establish a trust for the benefit of my kids and sell it to the trust and have the trust give me back a note. I could do things like that. One of the reasons and how we do that is through the use of an intentionally defective grantor trust. Okay, intentionally defective grantor trust. These types of trusts have a couple of different characteristics. Characteristic one is that income tax liability is on the grantor. So any income that's generated by the trust, the grantor of the trust, the creator of the trust, the settlor of the trust, same thing as grantor, has to pay the income taxes to the IRS. All right, so all the income tax liability on an intentionally defective grantor trust falls to the grantor. The next thing is the corpus, which corpus means all the assets in the trust. Anything in the trust is called the corpus. The corpus is not estate. All right, it's not estate included. Meaning that the property in the trust is not in the estate of the grantor. So it's a cool trust. It really is a trust that is, it really is a trust that has dual purpose. And the reason we create these is not because I'm going to, as before we said, I could create a regular simple trust, right? Where I just put money in and it pays income out to the beneficiaries. That's fine. I could create a complex trust where whatever the beneficiary is not paid out and retained by the trust, if it's income, the trust is going to pay that income, and pay the taxes on that income at the trust tax rates. And the trust tax rates go to, the highest marginal tax bracket over $12,000 and change of trust income. So if I could create a trust that fell back on me the income tax liability, but the assets were out of my estate after I gifted money or to that trust or sold anything to that trust, then I got the best of both worlds, because remember, I'm wealthy. I'm not doing this because I'm poor. Okay? I'm wealthy. I got a lot of freaking money I got to get out of my estate. And if I'm paying the income taxes on the trust, it's like giving my kids a gift with not having to count it. Because if that trust owed $50,000 or $100,000 of income taxes just on the trust assets, and I'm paying the tax, isn't that like I gave the trust $100,000? It is, because the trust doesn't have to pay any income tax. So the trust gets to continuously compound its money through new investment of whatever that income was. So it works out very, very well. So an intentionally defective grantor trust is huge, huge. Now, what we do, let me come back here, put an arrow here. What we do is we will place assets in this intentionally defective grantor trust. And we can place assets in this trust in two different forms, okay? We can place the asset through a gift, to the trust, which is like any other gift, or we can place these assets in this trust as a sale to the trust. So there's only two ways to get in the trust. I got to sell it to the trust, or I got to gift it to the trust, right? Now, when we create this stuff,
Oh, my God.
John, don't freak out. When we create this trust, we do it with the intention usually of selling a large asset to it. So let's say over here, we have the, let's see here, the client has their family business, okay? See if I can put text in. The big B, the family business. And what they're going to do is dad is going to take, or mom's going to take the stock of this business, or the LLC interest, or the limited partnership interest, and they are going to sell these interests to this trust. They're going to sell those interests to this trust. Now, to make this trust, in the eyes of the IRS, look legit, if this was $10 million in sales, we're probably going to want to put $100,000, $200,000 of cash as a gift to the trust, to seed the trust. That's to make it look like it's just not there to create this transaction. And that's important. The IRS likes to see seed money. So whatever that may have been, we'll put a little cash in here in the practical side of this business, and we'll sell these assets to the trust. Now, what the kids are going to do is what dad and mom are going to get by selling this asset to the trust, right? This business is going to end up inside this trust. In fact, I don't know if I can select this thing. Put that here, select this. So the business ends up in the trust. And what we're going to do is we're going to now, the trust is going to pay mom and dad out principal and interest payments for this note. So this note could be, a 10-year installment note. It could be whatever we wanted to do. But the idea, or what we do is we just make it right now, or we just make it like interest only if we want to. It just depends. Like right now, 1.14% long-term rates. I don't see why I can't make a 20-year deal or a 10-year deal at 1.14%. The assets in the trust will probably throw off. So assuming this is $10 million and we had to pay out $114,000 a year in interest, between mom and dad, that's $50,000 each that they could write off under their lifetime exclusions and their annual exclusions, potentially through gift splitting. Which means, at the end of the day, the kids have this business. The trust is for the benefit of the kids. And this business, this asset right here, is growing and growing and growing over time. So what's in the client's estate? Just the value of the note. That's called an estate freeze again. We're frozen the value of the note. So it's great. So basically you're swapping an asset for a fixed note, fixed instrument at a stated rate of interest, and saving a ton and getting the growth out of your estate. And that's what all these techniques are about. Getting the growth out of the estate, continuously getting the growth out of the estate in various ways to do it. So they work rather effectively, and it makes a lot of sense. Now, with that said, I'm just going to stop this particular share for a second, and let me quickly share this desktop again.
What happens to the capital gains once you sell it to the trust?
Well, it's great. You have to account for it. It's just like an installment note. You're going to have to account for your cap gains over time. Okay, that's what happens. All right, so if I go back to the my number cruncher, everybody can see it, right? Just making sure, right? Everybody sees it? Good. And I go back now to what I showed some of the guys last night, to this graph. So the simple techniques we just learned about, you might not say they're so simple. You might be saying, Ben, what are you, crazy? But these techniques are all, again, freezing techniques. A grant to retain annuity trust, and I mentioned it last class, I just want to show it to you one more time, is just another way to do this. It's a way to freeze and a way to get appreciation out without making any gifts or doing any sales. All right? So really all you do is, in this particular case, I took $1 million and I threw it in a grant to retained annuity trust. It's $1 million of Apple stock today, trading at 100 and whatever. All right? And I'm going to hope that this Apple stock appreciates at a rate of 9% a year, and that it's going to pay out about a 2.8% dividend, right? I know that the applicable federal rate right now we're going to use about 0.4. We can probably, for long term, we should probably use 1.14. Okay, and everything, or 1.2 it wants me to use, whatever. So we're going to do $1 million. We're not discounting anything. And what I'm going to do with this client is they've agreed over the next 9 years, over the next 10 years, that they're going to take $1 million of their Apple stock back. That's the operative thing. They're not taking back cash, guys. It's a value. They're going to take back $1 million of their Apple stock, basically a little over a tenth of it a year, back out of the trust. That's all. So if I'm going to take back everything I put in, I didn't make my kids any gift. The kids got zero gift. And then you can see the rounding error down here. They have to take out over 10 years $106,717 back out of this trust. And this is for the now if I said that there was no dividend at all, then the numbers don't even change, you can see. So the reason I put the dividend is because who do you think pays the income tax on this dividend in this trust? It's a grantor trust, like an intentionally defective grantor. The grantor. So they'll take $106,000 of Apple stock, whatever shares that is, equates to that value at that point in time, they'll take it back. And over this period of time, what we're doing is we're taking this out at the end of every year. They're going to take back $999,999. It's just going to work out that way. There's going to be a partial year in here. And really, the taxable gift to the kids is 86 cents. We probably won't even report that. We'll just say it's zero. Okay? So if I look at the schedule, we put the $1 million in. It grows by $90,000, 9%. It makes $29,260 of income, and I pay back $106,000 back to myself or me and my wife. And what do I have left? $112,000. Well, rinse and repeat on that 9% growth rate and that fixed payment back. At the end of this trust, it's grown by $970,000. It's made $315,000 of income, in which I've paid the income tax on, probably to the tune of $100,000 and change. And I've taken back $1,067,000 of my stock over all these years in like kind. I just transfer the shares back to myself from trust account A back to my personal account B. And what's left in the value of stock in this trust is $1,219,313. That money goes to the kids outright or into another trust. Zero gift and estate tax. Zero. We don't have to fill out a gift tax return, because all we did was create an appreciation machine that every year I took back what I put in at 1/10 at a time, and what's left over, just the appreciation, my kids get to keep. It's very similar to some of these other techniques. In an intentionally defective grantor trust, if 10 years from now the money doubled and that business value doubled, and I wanted to foreclose on my note and get my principal back, I could. and get all my principal back. If I was just doing an interest-only note, we could do a balloon payment back to me of my value. It's the same thing. Just this is a way that we have this annuity designed to do it. Yes, sir.
So you might have answered this last night, but so God forbid, what if it were like Enron or WorldCom or something that you transferred and you never could get back your annuity payment? What happens?
No big deal. It failed. No loss. It failed. No loss. No problem. No, the thing just failed. No big deal. Okay. All right. So that is we do the GRAT, it's fixed payments. We do the unit trust GRUT, it's unit payments. And I suggest you go back and look at that in your textbook. We covered it last time. We just wanted to cover it again. Now, the next section is these qualified interest transfers are really, I'm transferring my business interests. That's what it means. It doesn't mean interest like on money. It means my business interests. I'm going to transfer it. So these are ways in which I can create the agreements to buy and sell shares of my company from other parties. And the recapitalization transactions are ways in which I'm going to prepare my ownership interests in my company for future transactions to my children, usually. Okay? Let's get here. So, a buy-sell agreement is, I pulled my back out today, so I'm moving slow. A buy-sell agreement is a arm's length transaction. An arm's length transaction is something that's between two parties we agree upon rather quickly. It's an arm's length transaction. So I agree, or I'll talk about some clients I've done this for. I have two clients right now. One client, they both are business partners in an internet firm, and the company's worth, I don't know, whatever it is, $3-4 million. And in the event, so they create an agreement. The agreement can be a standalone agreement, or it can be an amendment to an operating agreement of a company or a partnership agreement of a partnership. And it basically outlines what happens in the event of triggering events. Triggering events. Triggering events are death and disability, dissolution, the business fails, disagreement, between the parties. So it lays out what happened. Divorce, we call them the 5 Ds. So the contingencies that can happen to a business owner. And what happens to the ownership interests of the company under any of those conditions that may take place. Specifically, death and disability is the big one. So let's say we had two business owners, and they decided that in their agreement it says, we're going to value our company at X amount of money, let's say $4 million. I own 50%, or partner A owns 50%, partner B, or shareholder A and shareholder B own 50% each, $2 million. If partner A shall die, or shareholder A dies, they agree to bind their estate, that their estate has to sell their interest in the business to the surviving business owner, to the remaining business owner, at an agreed upon price struck by either formula or amount inside the operating agreement / buy-sell arrangement, whatever the deal is. So that is, and then in the event the other partner died, the reverse would take place. And the reason why you want to do that is, of course, really a little bit beyond the scope of this class, but you just don't want the family of a decedent partner inheriting the business and then walking into the office and expecting a check for 50% of the profit when they do 0% of the work. Okay? It's a big problem. Having two business partners, whether they're shareholders or partners, or whatever the ownership form of the business is probably a little bit more intense than any marriage. At least most marriages, if at least one person works, the other party disappears. They don't see them all day. But imagine being with your business partner all day long. So it's really quite the relationship, and relying on each other to make money. So if one of them dies, they want to sell it to the other one. So that's what these things do. Or in the event of a disability, how long does the one partner A have to be disabled before partner B wants to buy them out, and under what conditions? Now, you could strike these deals where there could be installment payments. You can strike these deals where we put life insurance to pay for this in play, no matter what. But from an estate planning perspective, why do we care? We care because if the partner is wealthy and subject to inheritance tax, the business assets are included in the gross estate of the decedent partner or business owner. That means the IRS wants 40% of that value. And you got to come up with the cash to do it. And meanwhile, the business is trying to run, and the IRS is now the lien holder, if you don't pay that tax. So we have to come up with a mechanism where the estate can transfer those assets, get this cash vis-a-vis life insurance usually, and then the estate has this cash to pay off the IRS. Now, buy-sell arrangements work incredibly well, not only with individually unrelated business owners, but with their children. When somebody dies, remember, we get a step up in value of their assets at date of death. So if you had a business that you had a low basis at death, its fair market value is your new value. But of course subject to estate tax because it's included in the gross estate. Okay, fine. If I sell that business, or the estate sells that business to another party, what price are they selling it for? Well, they're selling it to that other party for fair market value. The cash comes back. So not only did the estate, there's no capital gains on this transaction. The estate gets the cash for the stepped up in value, and the new partner buys the company, 50% of the company, or whatever the percentage is, at the stepped up value, increasing the partner's new basis in the company, because he gets fair market value for half the company and his original cost basis for the other half. It's very cool. So everything gets stepped up, and if you create life insurance or some type of cash regime, it can happen rather quickly, and you've funded the whole transaction. It's very important. Now, I had a client in Miami, owned I think it was like an $8 or $9 million company, and did this deal, but him and his wife were parties to this transaction, and their son. And what they did was at death, Mr., through the unlimited marital deduction, left the entire company to his spouse. All right? They used his exemptions for other things, other assets. Left the entire company to his spouse. The two of them together did a deal that bound the wife at her death to sell the company to the son. So that means during her lifetime, she could still get income. The son worked in the business, not a problem. And when she died, their second to die life insurance kicked in, bought the entire business from the mom at fair market value, and then the estate got all the cash, in which they paid the estate taxes, and then what's left over, where do you think it went to? It goes all the way to the son, all the other assets as well. So the son got to buy the business at a stepped up basis, and what was the cost of this transaction? The life insurance premiums, which were substantially less than the value of the company. So we eliminated pretty much, we found a mechanism to pay the estate tax drag on the entire estate, but that was about it. It was pretty cool. So you can do all sorts of transactions here with buy-sell arrangements. In the insurance course is when I really went over this, and I did the how many policies do you need, the different types of buy-sell arrangements. That's not the scope of this class. The scope of this class is for you to understand how the transaction and the tax liability, the estate tax liability and transfers on these types of things. So each owner, again, obligates himself to sell his interest in writing. A cross purchase is when buyer A buys from buyer B, and buyer B, if there's three partners, A and B dies, A and C buy B. If A dies, B and C buy A. It works like that. An entity purchase is different. An entity purchase is all the owners agree that the business will buy back the shares at death of the decedent owner. The business will buy it back. It's a buyback plan. And they'll buy it back for the fair market value that they set in the agreement. How do they fund the buyout? Usually with life insurance again, or an installment deal. But most estates don't want the installment deal. Most surviving spouses don't want installments. They want to be bought out and be done. So it works very, very effectively. All right, let me come back here. So recap me. So why would I do a recap or an entity? Excuse me. Why would I do an entity purchase versus a cross purchase? If I have 4 business partners, and I have to come up with a regime where B, C, and D buy A, and C, D, and B buy this and that, and I have to then have 16 life insurance policies. If I have 4 partners, I need 12 life insurance policies. It's a pain in the ass. I could have 3 policies and have the entity buy them out, and it's simpler. So it's a much easier way to go. Read up about this in your text, some of the more minute details, but that's generally what you're tested on. All right. Let's go to recapitalization. We have situations where I own a company and it's all common stock of my company, and the common stock has a fair market value, right? My company has a fair market value, and each share is worth however many outstanding shares there are divided into the fair market value equals the value of each share that I have. I'm in full control. I'm a control freak. I love my company. I'm in totally control. But I realize now that I have to start making plans to transfer my business slowly or eventually to my kids because they want it and I don't want to be in it after a certain point in time. So in order to incentivize my children or other key people in my organization that I may want to provide shares to, I may consider recapitalizing my company into voting and non-voting shares, right? So I can recapitalize my stock into voting and non-voting. I could create preferreds and common and stock if I want to. I can hold back and I can own all of it up front. And then slowly over time, I could gift or sell non-voting shares. Now, the cool part about selling shares that have less rights, non-voting, meaning less rights than my shares, my preferreds or my voting common, is that I can discount those shares for lack of marketability, lack of minority interest, and lack of control. I can discount those shares, and so if I knew that I could get a 30% discount on something, so if it was 10 million, I could take 30% off the top and call it a $7 million sale or gift to my kids and give them $10 million in shares. Or if I know I have an $11,580,000 exemption and I want to give the kids non-voting stock, I can gross that up by 30%. So I can give them 14 plus million, take 30% off, and it becomes 11,580,000. I fill out a gift tax return and we're done. The kids got a lot of the business in non-voting shares. Okay? So the IRS has some specific rules. Chapter 14 comes into it, which is about valuation of these shares. Because the one thing we don't want to do, you can't just say that I'm going to create voting and non-voting. I have a $10 million company. I'm going to create voting and non-voting. And my voting shares are going to be worth 10 million and my non-voting shares are going to be worth 0. Right? You can't do that. And so we have to be able to account for this. So you can't just give the kids 0 and expect that it's going to appreciate over time and so forth and so on. So we got to be careful. So how you do that, you possibly have to change your entity type to be able to have voting and non-voting. You'll create multiple classes of ownership interests, and then you have to kind of figure out which ones do you want to give the family and which ones you're going to retain over time. Whatever you do give the kids, remember, it's going to be some gift tax liability potentially on that, or you're going to have to sell those shares to them in an installment note, sell them to an intentionally defective grantor trust. You see how all this stuff piles on? Everything is the same, and you just keep using multiple techniques. So why would I recapitalize a business, take substantial discounts, and sell it to an intentionally defective grantor trust? I don't know why I wouldn't do that. I could. It just, again, try and explain all this to a client. All right? It takes time. So each little piece has to be explained. So these recap. So you will, what's included in your estate is whatever you own that you haven't given away or sold, right? And remember that all these shares, you have to pay. The business makes a profit. It's got to pay income out on them. It's got to distribute the money. So your kids are going to get distributions, and you have to be cautious. The one thing people need to realize, even if you have non-voting shares out there, or selling non-voting shares, or selling any part of your company, any ownership interest, you're opening yourself up to audits. So if you sell it to your kids could all of a sudden come in and be pain in the neck and want to see all the books. So they could take you to court for lack of leadership, or you're not managing the company and have you removed. I mean, it's all sorts of crazy stuff. All right. Here's some advantages and disadvantages of buy-sell. Advantages or disadvantages. Increase the basis for surviving owners. A cross purchase does yes. An entity or stock redemption agreement does no. Okay, if it's a C corporation. Number of policies required. I showed you that. Only one policy per partner. Cost. Inequality of considerable age difference among owners. Well, if you're buying life insurance, it can be a lot. It could be expensive if you have one older partner, sometimes it's hard to get through this inequality issue. And other death proceeds are income tax free to individual, and we can get possible dividend treatment for corporate entities is a possibility with entity purchases where you may get some div taxes like it was a dividend. The redemption of the shares could be like a dividend, which brings us to something very interesting. There's this thing called the Section 303 redemption to work with these entity purchase arrangements. And basically it says, if your estate, if your business is greater than it's 35% or more of your adjusted gross estate. So the value you own is 35% or more of your adjusted gross estate. When your stock is a normal stock redemption. If my company right now redeemed my shares, it would be treated as a dividend to me, to some extent. Okay, the profit on those. In a stock redemption plan, if I own 35% or more of the company, I could file for a 303 redemption, which will treat it like a purchase. So it treats like the company bought it from me. And and at death, if the company, happens at death, if the company bought it from the estate, then whatever the value the company paid is the step up in basis in the stock and the value that's included in the estate. So it's very interesting. Read up about it again. But this chart's pretty cool. This is where I pull test questions from. Not much more. I've pulled this test question on the number of shares per owner. I've pulled out what is cross purchase, what is entity, what does that mean, stuff like that. Nothing crazy. Here's a good question. Bob, Frank, and Francis are equal partners in a closely held business. No partner's ready to quit or retire, but all worried about the business would operate if one of the other partners left the business due to death or disability. Each partner is financially overextended and thus does not enjoy good cash flow currently. Which of these is the most correct business transfer technique for the partners to use, considering the above circumstances? Well, the thing about the cash flow is that the business could pay for the redemption agreement, life insurance, if we wanted to. So an entity buy-sell agreement between the business and each partner is, that's possible. A private annuity, no. A cross-purchase buy-sell among the partners, it's always an option. A preferred stock recap, nah. So an entity buy-sell, as I mentioned before, would probably be the most appropriate. And the reason is because the partners are overextended. They most likely can't afford to purchase life insurance policies in a cross purchase, so the business would do it. I don't know how really true that is, because if the partners have poor cash flow, then the business probably has poor cash flow. All right. We're moving along. So always when we're transferring our company, it's like transferring any other asset. We're going to have gift tax implications if we transfer it while we're alive. At death, it's going to have some estate tax implications. There could be some income tax implications, maybe an adjusted cost basis issues, and there could be some depreciation recapture. There's going to be all sorts of little things when selling a business. So it's important that, of course, the business, you get to the client's accountant and let him calculate or her calculate what the tax implications absolutely going to be in whatever methodology that we think is most appropriate, whether that be a buy, sell, outright sale to a defective trust, selling the company now to your children, selling the company now to your business partners or other key employees. I spend a lot of time business owners talking about their strategies to exit their companies. So all these considerations come up quite often. And of course, there's the non-tax implications of losing control. All right, here's a recap question. Which of these statements regarding a preferred stock recap freeze transaction is not correct? Remember, why am I doing this? Again, it's just a freezing technique. If I'm holding back, if I recap and just hold back preferred stock that pays a stated, like a par value with a stated rate of return, that's a frozen amount of value. And if the common stock my kids own, that's an that'll appreciate. So there's lots of little things here. It's still freezing techniques. They're all freezes. If shares are gifted, which one of these is not correct? If shares are gifted to other family members, the donor may be able to claim discounts from minority interest and lack of marketability. Possible. If shares are gifted to other family members, they are valued as of the date of the completion of the recapitalization. Whoops, sorry. Okay. If shares are gifted to other family members, the Chapter 14 rules may apply, and recapitalization may be costly and require a change in entity. Dum 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 dum. B. So we don't value them necessarily in the date of completion of recapitalization. We value them on the date in which we transfer the shares. That might be a completely different date. Okay? Value the date of completion of the recap. The valuation will determine the date of completion of the gift, as I mentioned. All right. So we have business owner clients, guys, right? And this is where we're talking about this stuff because you know that most of the wealth in the baby boomers is tied up in business. There's like $12 trillion of baby boomer owned businesses out there right now that are going to transfer in the next few years. So understanding this marketplace and being able to advise your clients is pretty cool. I mean, it's a good thing to be able to do. And again, you know, not every transfer technique matches your particular client. So a buy-sell agreement ensures, again, we look at the insurer market. If you're doing a buy-sell, we know who's going to buy it. It ensures the market. Ensures it will have a market. Okay? Recap doesn't really, we don't really know what we're going to do with a recap, but it makes it easier for your kids to buy the shares. If we want to get the business out of the gross estate, none of this stuff does it, right? A recap will do it, but just whatever we gave away, whatever we keep stays in our estate. And if we want to avoid or reduce gift tax, a buy-sell agreement avoids gift tax since it's a sale under Chapter 14, and a recap avoids if the business is sold at fair market value. All right, so it's simple. These items are pretty simple. What are our objectives? We want to freeze the business interest value, so that's going to be a recapitalization, not a buy-sell. Because again, recap is I'm taking back a fixed instrument, something that's not going to grow, and I'm going to get the growth out of my estate. Shift taxation of income from business interest. Buy-sell won't do this because it doesn't take place until a trigger point, but a recap does. And if we want to avoid capital gains, a buy-sell certainly does. A recap should be no recognition of gain on the formation of the new entity or the recap, but when it's sold later, you could get some taxes and capital gains. Which of these statements regarding business succession planning is correct? Developing a business succession plan for a small business owner can be challenging. Absolutely, it can be. One challenge of business succession planning is that the new owner of a business may have difficulty adapting to the idiosyncrasies of the client's business. Yep. Business succession planning may involve family issues that the business is family owned. Yep. And determining the market value of the business may be difficult because many small businesses are closely owned. Wow. D. Every one of these is right. Okay. Every one of these is a complication to doing business succession planning. All right. We are rounding the bend here. Okay. So I spoke and I kept mentioning life insurance, life insurance, life insurance. It is, because of its very nature, it's a leveraged financial instrument. You pay X amount of premium to get a much larger benefit. It's a leveraged transaction. Some people say it's a waste of money. I haven't seen one that's ever been a waste of money. It's only in your head. All right. It's a waste of money because you don't get to see the enjoyment of the benefit. Your family does, right? You're dead. So you're paying money out. It's going to go nowhere. But look, if I stare at my bank account, it does me no good unless I take money out of it and spend it. And one day, whatever's left is going to go to my kids. So I don't know what the difference is really. But people get a little squirrely also about dealing with their own mortality. No matter what, life insurance will provide a lump sum in trust for estate liquidity. It always does. It pays off debts, helps you achieve other objectives, like maybe even charitable donations. It can replace your income if you die prematurely. It can help you accumulate wealth for your kids. Death benefit received income tax free, but not gift or estate tax free unless it's in trust. And the death benefit, if you own it, again, will be included in the gross estate, but in your gross estate. But if you own a trust, the life insurance owned trust, it will not be. All right. What type of policies are? If you took my insurance class, we beat this up. Term life insurance for a specific term, or permanent policies, I should say, that have potentially cash value. Can be written on a single life basis or a joint life. We do a lot of joint life for estate planning because the estate tax is typically due on the death of the spouse. The second spouse to die is when the estate tax is due. So a lot of times we'll do first to die life is kind of stupid, never done. It just means that you have multiple parties on the policy, but sometimes use it for buy-sells. It's hard to find. I don't even know any companies that sell it anymore. But second to die is sold all the time in single life. Second to die or survivorship life insurance. How much do you need? Well, it goes back to our math. We just figure out the estate tax liability, apply some growth rates, do cash flow analysis. Just about every one of you, if you work for a financial firm, has software that can very easily calculate how much insurance somebody needs. I guess it's if your gross estate is anything above $11,580,000, you need 40 cents for every dollar above $11,580,000. Next year, depending on where the election is this next week, you may need 40 cents, 45 cents on every dollar above $3.5 million for your client to pay their taxes. We'll see. Do not know. Either I'm going to be very busy and quit teaching you next week, or I'm going to keep teaching you. We'll figure out what happens. Life insurance settlement options. This is very simple. This is just when you die, well, how does your family get the money? It's as simple as this. Do you want an insurance company to just pay out you interest only? No, that's stupid, but they love that. The insurance company loves that. Fixed period, pay you out all the money over a fixed period of time. Well, again, great for the life insurance company, shitty for the beneficiary. Fixed amount option, again, great for life insurance and life income. All these options are terrible. What you want is cash, paid up front, real quick. Give me, what is it? Show me the money, okay? Show me the money. All right. We talk about beneficiary designations. There's really two types of beneficiaries, primaries and contingents. The contingents take over if the primary is dead. Revocable and irrevocable. You can change the revocable ones, and if you create an irrevocable beneficiary, it cannot be changed. Okay. How do you plan with life insurance? We put it in irrevocable life insurance trusts. We use it for buy-sell arrangements. We use it to provide income, and it's pretty important. Why do we talk about This is important. Inclusion, valuation, and transfer for value rule. Let me just come back up here for a second. So there's this code section 2025, I believe it is, that says if you own your life insurance policy, no matter who the beneficiary is, if you're the owner, it's going to be included in your gross estate. Depending on how big your estate is, it may be a bad idea. Okay. Remember, if you're leaving a single life policy to your spouse and you're the one to pass away first, big deal. I mean, it's got an unlimited marital deduction. But if it's if it's such a big policy, it's going to cause your spouse to have, upon her passing or his passing, to have a estate tax liability. Then I don't know. We want to look at owning it inside of a trust to avoid that. When you transfer a life insurance policy, meaning I can sell a policy or I can give a policy away, where would I be selling or transferring? I could be selling it to my kid. I could be giving it to my kid. I could be selling it to a trust. I could be giving it to a trust. Whatever the point, or I could sell it to a private party for that matter and take cash. That's another story. But transfer for value is that if I sold you my mouse, there'd be a transfer for value. What's the value? You got to give me back something for this, right? Value. So if I transfer a life insurance policy to an irrevocable trust, now let's just keep something straight in our heads. We're talking about, we have transfer for value issues where we could potentially be creating a gift or some type of sale transaction. Pretty much with anything we do, right? Now, when we do life insurance trusts, the IRS says if I gift a life insurance policy that exists prior to the trust existence, the operative date of the trust. So my client Joe had a $5 million life insurance policy, comes to me for planning, and I said to you, Joe, that should be in an irrevocable life insurance trust. And Joe says, great, have the attorney draft one. And we go and have the attorney draft one, and Joe gives the policy to the trust for the value of the policy. We'll talk about its value in a second, valuation. The IRS says if Joe dies within 3 years of that gift, the death benefit will be brought back and included in Joe's estate. If Joe survives 3 years, then it's not included in Joe's estate. All right? That's a transfer for value issue into a trust. If Joe sold the policy to the trust for some value, there would be no 3-year rule. All right? Because the trust would have to buy it from him and this transaction is complete. So there's just a special rule for transfers into trusts that don't exist. Now, when I do business and I'm doing trust-owned life insurance, I tend to have the client underwritten without an application. They don't buy the policy, they just get underwritten. They get an offer, oh, you look preferred. Then we go to the attorney drafts a brand new trust. Then we have the trustee sign a new life insurance application and the trust buys the policy. And we do not have a transfer for value problem at that point. How does the trust pay for the policy? Well, the client gifts money or loans money to the trust to make the premium payment. That's not a problem. There's no transfer for value there. So we talked about how it could be possibly included in the gross estate and transfer for value issues when it comes to life insurance. Business partners have an exemption for transfer for value. If my company transferred me my own life insurance policy that my company owned, there's no transfer for value. If my business partner and I had life insurance on each other and we transferred the policies to each other, there's no transfer for value. None at all. Okay, it's an exemption. Valuation is important. It's how we value that life insurance policy. Now, there's many different methodologies. There's a thing called PERC, policy replacement cost, but it's generally speaking, here's how policies are valued. If it's term insurance and it's January 1st and you just paid your $1,000 premium and you, on January 2nd, you gifted the policy to a trust, the gift is probably the $1,000 premium for the year, okay? The unused premium for that year. If you did it 6 months later, the gift would probably be $500 because that's what's left of the premium that the carrier hasn't used yet. If it's a cash value life insurance policy, it tends to be the cash value. Now, but that's not exactly perfect. We have to go to the insurance companies and ask them for a valuation. So a lot of times it'll be the cash value plus a little bit of a difference. So maybe if it's a $200,000 cash value, might end up being $206,000 to be exact. You get a letter from the insurance company called a 712 letter, and they tell you what the policy value is, and you can use that to keep with your records for gift tax purposes if there's going to be any, if it becomes a taxable gift to give the policy to a trust. So we need to know what the value is. But if you have an 80-year-old, 87-year-old, and they have a $500,000 policy, permanent life insurance with cash value, and they want to give it to their kids, what's the value? What's the transfer for value rule? Is it the cash value of the policy? No. Because the policy might not have any cash value. It might be one of those fancy guaranteed universal life policies with no cash. So the government says is, how much would it cost for a single premium policy at that age if it was purchased to provide that death benefit? So we'd have to go calculate that at 80 some odd years old. It's probably damn near close to the death benefit. That would be the gift to a trust. So depending on how old you, the closer you are to life expectancy, we go with policy replacement costs. The younger you are, we just go with unused premium if it's term, and if it's life insurance with cash value, we go with the cash value plus an age factor. An age factor that the insurance company will factor in for us. We ask them for that information. All right. We talked about the irrevocable life insurance. Just as a methodology, though, just I want you to let you know this, that you can't draft a trust. A grantor cannot draft an irrevocable life insurance trust and put language in there that says, the trustee shall pay my estate taxes. You can't do that. If you do that, you're the grantor is dictating how the money is going to be used in that trust, and that's control. If you have any control over trust assets as a grantor, then that is a trust that said you have a power of appointment, you control the money in that trust is going to be includable in your gross estate. So you don't want that. So you'd never say that, but it's understood what happens is, let's say you had a $10 million payout in trust for benefit, and what the beneficiaries of the trust would do, or the trustee would do, is go to the decedent's estate, and let's say that estate had $30 million in it with a $12 million or $10 million estate tax liability. The trust would buy $10 million of assets from the decedent's estate and give the estate the $10 million cash. And that's a swap, an asset swap, and trusts allow for that. That way the estate gets the cash, and the estate and the estate administrator now has the money to pay the taxes. And then when the taxes are paid, really that $30 million in the estate then goes to the kids, probably in the form of another trust. Because either testamentary, or it was in a revocable trust to start with, or other types of vehicles. But eventually, that's how the mechanism works. The trust, the life insurance trust buys assets from the estate or loans money to the estate to pay the estate taxes. It cannot pay the estate taxes directly or violate the rules, and the trust assets would all be includable in the gross estate. We just don't want that to happen, right? That's a big mistake. Okay, we have just a couple more slides left. Let me just see how many. I don't think there's 100. I lost track. Holy crap. Okay. No problem. All right, guys, why don't you do this? Go take 10 minutes. It's 8:27. Come back at 8:40 and we'll pick up again, okay? Cool. I'm going blank.
Ben,
Yes, Fedra.
is an iClat something new?
An iClat. I don't think so. Not that I don't know. Maybe. iClat.
Yeah.
I don't know. ICLAT.
I was invited to attend a call.
Oh, reversionary
Like,
charitable lead. Interesting.
wonder if that'll be tested next year in March, right?
Yeah, who knows?
Nice.
Right. Something new. iClat. Where accessibility of CLTs, charitable lead definitions, CLT backgrounds, grantor, non-grantors. Tax purposes, reversionary charitable lead trust, which by its very terms calls as a grantor trust for federal income tax purposes on IRC 673 knows that somebody reverts back to the client at the end of the charitable lead interest term in a non-taxable transaction. Pass share the client's family. Most CLTs and iClouds much simpler. Or CLT for clients and cloud from which compares efficiencies. iClouds necessarily for income tax savings versus every case. That's much simpler than trust principle. Okay, Fedra, I figured it out. So all it is so typical charitable remainder trust, when you create it, you know that you're creating an annuity payment back to the grantor of the trust, and you're getting an income tax deduction for the remainder interest that's going to go to the charity. Typically, in order to qualify, you'd have to have at least a 10% of the value of the trust has to be left to the charity. It's a minimum threshold. In an ICLAT, it's just the reverse. So, or it's in a lead trust. So in a lead trust, it's always been held that what we've done is we've created a situation where we donated money to the lead trust, and generally it's for an estate tax savings, and it's done at death a lot of times, testamentary lead trust. So you leave money, and you're getting the present value of the payments to the charity. The charity gets income for a period of time, thus charitable lead, and you get a deduction from your estate, comes off your estate tax liability for the present value of the income to the charity. And what's left in that trust goes to your kids. So now what they've developed is an inter vivos trust, a lifetime trust, where it has nothing to do with estate planning. It's just an income tax planning thing. You get a present value income tax deduction for what goes to the charity. Hold on one second. Hey babe, I'm in class. All right, talk to you about it. So the ICLAT, you're getting a present value income tax deduction for the payments that go to the charity, and the remainder interest comes back to you,
Okay.
yourself.
Thank you.
It's interesting. Another twist.
Yeah. That's
Another
all
twist.
my case.
All right, guys, everyone show your faces. Let me see those happy smiles that you're all still awake and ready to go and rumble and keep it going. Hey, I found some, I just got my Zoom updated, and I've decided they have now filters. I found my new filter. I kind of like it.
Yeah.
My wife always says I'm an angel. So, thought that was pretty good. It's better than this one. So, but I think I'm going to use this for my Halloween meeting that I have coming up. Anyway, kind of incredible what technology can do. All right, we're here now. We talked about the irrevocable life insurance trust, and now we'll just move a little on to, a couple more business uses of insurance, life insurance specifically. And of course, this is where sometimes our classes kind of overlap. And if you remember from the insurance class, if you took it with me, that we could do life. Businesses buy insurance. They buy group term for their employees. They buy, I'm going to skip over split dollar for a second, but they buy key person life insurance on their key individual owners and or executives in the event that somebody dies. The company would have an economic loss associated with the loss of a key person. We don't want that to happen. Okay, I'm sorry. And then, so that key person life is important in case something happens. And then, of course, we just talked about the funded buy-sell arrangement. And ultimately, split dollar plans are complicated. Not super complicated, but they're complicated arrangements in which basically the company, you're trying to give your highly compensated employees an additional executive benefit. So you're buying a life insurance policy, and basically you're loaning your employee the premiums. And then by loaning your employee the premiums, they owe you back interest on those premiums. But the premiums go into an insurance policy and accumulate cash value. So, and then you forgive that interest pretty much every year as income to the employee as a bonus. And at the end of the day, your employee owes you a certain amount of money, has a certain amount of cash value in excess of the loan and a life insurance policy. Then the employee wants to retire, and what the company typically does is either the employee cancels the policy, keeps the difference in the cash if the company wants the money back, or the company forgives the note at that point in time, that becomes income to the employee that year. And the employee then just goes into life insurance and withdraws the amount of tax, the money he needs for taxes, and keeps the rest. So it's kind of an interesting way to do things. It's beyond the scope, except of telling you what it is in this class per se. But in the insurance class, it certainly was something we did cover. All right. Here's a good estate planning question. Which of these regarding life insurance and estate planning is correct? I don't even know why it's doing the annotate, but life insurance can create almost immediate liquidity. Life insurance can finance business succession plans. Lump sum payouts are the only settlement option that makes sense in most estate planning cases. Yeah. And life insurance proceeds are always received income tax free. What do you think the answer is? 1 and 2. Because you don't know if they're going to receive income tax free. Depends upon the ownership. It could get screwed up. And 3, lump sum payouts are the only settlement option that makes sense in most estate planning cases. Me personally, I say yes. Technically, no. Okay. Advantages and disadvantages of life insurance planning. So there's just some slides you guys can look at. Insured is the owner, the advantages and disadvantages. Someone other than the insured is the owner, advantages and disadvantages. The big problem with owning a policy, if you're not the insured and you're own it outright, if that person dies, then where's the policy go to, right? And who's in control of the contract? So what's the point, And if somebody, let's say if a spouse owns a policy on another spouse and the owner spouse dies, then the cash value is included in the owner spouse's estate because no death benefit was paid out yet. The insured didn't die. So we want to take a look at some of these things. If the insured's the owner, the death benefit's included in the gross estate. The insured may be subject to gift tax if the policy is transfer for value. The owner and someone other than the owner, what's the disadvantages? The owner may name someone as a beneficiary who you don't want to be. The owner's estate will include replacement cost if he predeceases the insured. Remember that perk thing? So got to be a little careful here. Revocable trust is the owner. I do this not a lot, but I do like it sometimes. The advantage of that is the grantor of the trust retains total control of the policy and no gift tax on funding and the policy avoids probate. The disadvantage is that death benefits still included in the gross estate and the replacement value is included in the grantor's gross estate if the grantor is not the insured. Similar, right? Love the other slide. And cost of drafting the trust agreement. There's another huge advantage that they're not even showing here. And that is that in the event, especially for a parent and a child, if a parent dies prematurely and the proceeds are paid to the revocable trust, then they're in trust for the benefit of the beneficiary. I don't care about the taxes. They're in trust. And it's important because you can't leave a minor child all this death benefit. So if you are not worried about estate tax, then name a trust the beneficiary of a policy. That's a big advantage, and I'm sorry that they didn't put that in here. Advantage and disadvantage of life insurance planning. Irrevocable trust, all the advantages, out of the estate, tax-free, excluded from the grantor's estate. Disadvantages, gift tax on funding subsequent payment premium of the premiums. Yeah, you got to gift the premiums. Loss of control of the death benefit, maybe. It depends on who the trustee is. Grantor's income tax on trust income used to pay premiums of policies on life. That's a good thing, not a bad thing. If there's so much excess income in the trust that's paying the premium, that would be a good thing because then that's a gift to the kids. And cost of drafting, they always talk about cost of drafting. All right, I would keep reading some of these. These are not that big and bold and important. All right. No, I'm not going to test you a ton on that stuff.
What would be the cost of a simple trust?
No, not a lot. I don't know. It depends upon the attorney. I know a guy. I got a guy. He'd give you a good deal.
Yeah.
I got a guy.
Like buying a diamond. I got a guy.
I got a guy. You know, it could be, listen, a simple trust could be, I don't know, $500, $700 to draft. It's not that big a deal. It depends
A
on
complex trust,
Get more
10,000 or something.
1,500, 1,000 to 1,500. You know, depending upon the weather. All right, life insurance planning techniques to achieve estate transfer objectives. We talked about it already, over and over again. All right, name the owner has to be other than yourself. The death benefit should be paid to a trust. Simple stuff. All right, now what I want to do is I want to get into, the slides are finished, but I want to go over marital trusts. So let me go get my whiteboard. And let's save that. Okay, now let's clear. Okay. Oops. Can everyone see the whiteboard? You good? Good. Okay. So guys, we talk about, there's a methodology of trust planning. We generally call it ABC trust planning. All right. And it's not that difficult. So let me draw some things here. So we'll start off here, go here, and we'll do all right. Okay, so here we have, let's say the client is married and they're worth $20 million. Okay. And we're just going to say this is client number 1 in order of death, and this will be client number 2. They're married. Okay. And so this client over here has $10 million, a spouse. Okay, so now we know that, oops, whatever. We know that the estate, we had done some math on previous classes. We know that we have, let's assume this is a year where there's a $10 million, let's call it a $5 million exemption for each. 5 million here, 5 million here. So they have a $5 million each exemption. So classic estate planning would be, there's two options, or there's two things. There's first of all what most people do, because they're just don't do any planning, is they go ahead and they just die, right? And when they die, they just leave everything to their surviving spouse in what we would call an I love you will arrangement. Now, all the money, we know that when you leave it to a spouse, what we have here is the unlimited marital deduction. So we don't have any estate tax liability at that first death. But under this particular circumstance, what's going to happen is this 20 million would be left to the spouse. She would have 30 million, then subsequently at her passing, we'd have to deal with the estate tax liability. Now, nowadays, under this circumstance, what would happen is, I'll just draw a quick little circle here. What would happen here is we would have this 30 million, and this spouse would be able to subtract from the 30 million in her passing, $10 million would be the exemption amount, 10 million. And why is that? Because we have what we call portability now. Portability means that if spouse A doesn't use their lifetime exemption, I'm just assuming it's 5 million just for fun. If the spouse A doesn't use their lifetime exemption, spouse B inherits that exemption. So to have that happen today, spouse A at his death, they would have to do a estate tax return. You wouldn't owe any money because you put on one of the line items, all of it was being left to the spouse. But you have to check a box that elects portability of your exemption to check the box on the 706 form, the estate tax return. And you would do that, and then that spouse would do. So here the spouse would have 30 million, 10 million exemption, 20 million left over, assuming no growth, no expenses, no cash flows. At 40%, the spouse would lose 8 million in the transaction. That means the kids would get $22 million net. Okay, that's what would happen here if we did it this way with the unlimited marital deduction. So between you and I, we don't like doing shit like that. Okay, we don't do that stuff. I forgot I was being recorded and I keep cursing. So what we're going to do is something smarter. We're going to have
YouTube. It's cool.
Yeah, it's cool. Yeah, we're going to have this, we're going to wrap this money up. We're going to tell this client, look, this should all be right now, immediately, this should all be in a rev trust, revocable trust. Let's make a revocable trust. Let's put that money in there. At your death, Mr. Client, what's going to happen is we're going to create two trusts definitely, potentially a third trust. So we're going to create a CST, we're going to create a marital, just move that over, a marital trust, and we're going to create a Q-tip. Now the Q-tip is optional. We'll talk about that in a second. Okay. So another way we look at these trusts, and they're a little out of order, well, per se, but we do that deliberately. This trust is the B trust. This trust is the A trust. And this trust, the Q-tip over here, is a C trust. Okay? A, B, and C trusts. All right, so B stands for bypass trust. Bypass. Okay, stands for just another way to look at it. It's called bypass. To remember, it's B. Okay, bypass. A is A, C is C. That's all there is. Okay. So what we would do with an average estate plan, nothing there. No, so remember now, we're not going out and doing all sorts of other techniques. We didn't talk to the client about GRATs and GRUTs yet, or charitable remainder trust, or ICLATS is Fedra's new favorite trust. We didn't do any of that stuff. What we did was we just said, look, here's what, at least we're going to do this. At your death, we're going to take your exemption of $5 million and we're going to stick it in a credit shelter trust. This trust is going in when you do the estate tax return. This is the one we fill out the entire estate tax return at the end. At the end, we apply your credits and so forth and so on. But we have to work a little bit backwards. So what we're going to do is right up front, if we know we have a $5 million credit, we're going to say basically here that $15 million is going to be, we'll put down as the marital deduction for doing this. When we do the estate tax return, you remember that part of it, we talked a little bit about it when we did the gift and estate tax. But if we put $15 million down as the marital trust, we know that we're going to have the credit's going to be $5 million because it's going to be the credit. But for the actual tax return and this graphical representation of the tax return, that's all this is. the estate tax return. So we have this 5 million. We know it's going in the credit shelter trust, or we know otherwise known as the B or bypass trust. That's 5 million. Mrs., the survivor, generally, it depends upon we can make this trust one or two ways. So another phrase for this trust, is the family trust for the kids. So this B trust could be either, so this B trust can either we can give the spouse rights to the income and or rights to the principal, if we want to, and have that. We give the spouse the ability to take income and principal. They don't have to from here. And because what we want this $5 million to do is grow and grow and grow between these two deaths, because it's exempt from estate tax. Why wouldn't we want her to grow? Because even after she's gone, Mrs. dies, whatever this grew to is not estate tax when it goes to the kids eventually. So now, if they're very wealthy like this, where the marital trust, the spouse is going to get $15 million anyway, then we might as well we don't even have to leave this to the spouse. We just leave it right to the kids and let them have income and principal and corpus off this if we want to. We can do that. Not a problem. In this credit shelter trust. So that's kind of cool. Then 15 million goes here in this marital trust. Now, this 15 million, upon immediately, because it's in this marital trust, let me just get to my drawings. This 15 million goes over here now and becomes $15 million, and now this is, because it's a marital trust, Mrs. has full control over this trust. She has a general power of appointment. That means the entire trust is included in her gross estate. She can do whatever she wants with the money in this trust. She can transfer it. It's just in like, a marital trust is sort of like a revocable trust that was set up for the spouse, from whatever was left over, using the unlimited marital deduction. So she has full control over that. She's going to get taxed on the money that's in there. It's her money. Okay? It's her money. So the kids and eventually, so let me just do this line as well. Draw here. I'll just put this over here, a little bit over there, and because that's out of the estate, right? That's out of the estate over here in this area. So, whoops, I don't want that arrow. We'll just do a drawing of a box. So this 5 million is over here and it's out of the estate and won't be accounted again, ever again. Okay, that's kind of cool. So at this type of way, this is a good way to do it. Now, this Q-tip trust is another type of marital trust. In fact, it's included in her gross estate. The only thing this Q-tip does is qualified terminable interest property. We do this trust, it's a little bit more restrictive for the surviving spouse. The surviving spouse can take income from this trust, this trust is included in the gross estate of the surviving spouse. But the surviving spouse has no death time power of appointment over these assets. So usually we use these in second marriages, or we've had problems with our first spouse and trust issues, where we create this trust and it says, look, you can have access to these income from this trust while you're alive, my surviving spouse, but at your death, this is going to my kids. And if it was a second marriage, we would definitely do it because it's going to my kids, not your kids from a different marriage. So that's how we keep things in the family with this C trust or Q-tip. So right here, I'm not talking about that. We've got a first marriage. This is just how it is. So there's no need to do a Q-tip. There's no trust issues. It's not a problem. Okay. So this would be death 1, 5 million and 15 million. 15 million comes here, is included in the gross estate of Mrs., and then the 5 million. So what do we end up with? Okay. Now it's time, unfortunately, Mrs. passes away, and we want to see what's going to happen. Her total estate at this point now is 25 million, right? At this point. And what we can do and what will happen is her trust will break into 2 additional trusts. And those would be, oops, sorry, I got an arrow again. We have 1 box, 2 boxes. Okay, so this first one is going to be what? Her credit shelter trust. Now, the way we can do things, if these trusts are very similar and everything, we could, you know, for argument's sake, or to make things easy, we could just come over here and combine these 2 trusts, this 5 million and 5 million eventually. We don't have to do it right now, but we could eventually do that if we wanted to. And then, so 5 million then really ends up in here if the exemption stayed the same. And then and then over here would end up the other 20 million minus the estate tax on that 20 million, which is 40% or 8 million, which would equal 12 million. So ultimately, the kids will get this 12 million, the 5 million here, and the 5 million here. So that's 10 and 12 is 22 million. And the total estate tax really levied against this $30 million estate, again, was the $8 million. So these are how bypass trusts. Now, if Mrs. would have died first, we could have created a credit shelter. It would have been, we just put, 2 died over here and changed the numbers. But this is what we call A-B trust planning. The A is the marital trust and the B is the credit shelter trust. All right. The cool part is we hope this 5 million, we hope that maybe between deaths was 15 years at, or let's go 10 years just for fun. 10 years at 7.2% rate of return, this money would have doubled, right? Rule of 72, money doubles 7.2% every 10 years. So this 5 could potentially be worth, that went over here, could potentially be worth 10 million now, in between all that time. It just depends on how much money the family spends and what they're doing. But that's the point behind the AB trust. So people will make arguments that, Ben, you didn't have to do this because of portability. And as I mentioned to you up front, if the credit's ported, you're not using the credit till the second death. So you lost all those years of potential appreciation on the assets for no reason whatsoever. For no reason. So while one of the first things that happened when portability came out is that, oh, you don't need to do B trusts anymore. Because we're not, the only reason we did B trusts is so we'd have to use that credit at the first death or we'd lose it. But now we don't. It's portable. But I say no way, because the reason you do B trust if you're wealthy enough today is because you can shield all those assets outside the estate. Now, a smart thing that we do all the time is this 5 million, and you'll learn, we're going to get into generation skipping transfer tax in the scope of this course. This 5 million qualifies for your $5 million exemption, let's say, your death time, and potentially for $5 million of GST exemption, generation skipping transfer tax. So if I limit this money that goes in this CST trust to the generation skipping transfer tax exemption, that means I can make this trust a dynasty trust, and in Florida will not be taxed for 360 years ever again, all the growth on it. So there's a lot of stuff we can get away with this simple AB trust planning, but people freak out about it for some reason. They make it like it's very, 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 very complicated. It really is not. Just the credit goes in the credit shelter, otherwise known as the B or bypass. The rest of it goes in the marital trust, which qualifies for the unlimited marital deduction. And that's it. We wait, somebody dies, we rinse and repeat. That's it. That's all we do. But of course, we can get creative too. There's other things we can do here. Like I mentioned, you create the Q-tip if you're worried. You can create a generation skipping transfer trust out of this CST thing if you wanted to. Just so many little things to do. All right, now stop this share, and I'll talk to you all about what I think is going to be. You got to find midterm coming up next week. I will not be teaching that night. So you'll take the midterm. It's going to be 40 to 50 questions. I try my best not to complicate this test. I do my best. There are a lot of rules. I'll pick questions that are not nuts because, frankly, I feel bad that we're doing this on Zoom and I can't be in a classroom and I can't see your faces more, interact a little bit better. So I'll do my best. But it'll all be multiple choice. You'll do it online. You just go and log in. I'll make it available. Federal wanted me to make it available through, this tomorrow for you. But I will make it available the morning next week because it is election day. So you'll have all day and all night. And take it before the election so you don't get angry either which way it goes. Okay? So take it so you don't get pissed off. And you'll all do fine. If you need to do if you want to do, you have any questions, you have anything that you want to get in touch with me, just call me. And if maybe what I'll do again, if I get enough email, maybe Monday, I can't do it for 1 or 2 people. If I get 4 or 5, I'll do on Monday again another hour review if you want after you've studied the whole week. I'll be happy to do that. We can do a quick Zoom at 5:30 or 6 o'clock on Monday. Send me questions. So the way to study is do those multiple choice questions in the back of your book. I think I have an old study guide, but if it's worthwhile, I'll post it. But I'm using a lot more modern materials. The questions in those study guides tend to be kind of crappy, but I'll see what I have for you that I can post so you can play around. Let me see if I can go on there now before the evening's over for me and post a study guide. Okay, so check Canvas, the front page for a study guide for the midterm. I should be able to post something for you with the answers to it. And good luck. But please stay in touch with me. Yes, any questions?
Yeah, it's gonna be module 1, 2, 3, and 4.
What do you mean 1, 2, 3, and 4?
The modules for the midterm
The chapters.
chapter.
No.
Haven't done?
No, 1, 2, 3, and 1, just up to where we are now, which is the end of what? 3?
3.
Says 4. That's third.
Yeah, just where we are now, not 4. No, I'll catch up. Don't worry. This is a
Okay.
lot of material. Yeah, it's too much.
Yeah,
So-
chapter 3 is 70 pages.
Yeah. Just 1, 2, and 3 is where your final's coming from. My midterm.
Awesome.
Okay. Yeah. Oh, if you want, Hector, if you want 4,
No.
you sure? Just let me know. No problem.
I'm good.
I'll be happy to oblige. I mean, anything that makes you happy. So, so don't worry about it. It'll just be the first 3. Those first 3 slide decks, chapters associated with the first 3 units. Do all the multiple choice questions you can, and you'll be good to go. If I do post a midterm study guide, it's probably going to go all the way through 4 or maybe unit 4. So there'll be extra questions there. Don't panic, okay? Doesn't mean I'll be on the test. All right? It's just that I'm not going to go hunt. The study guide is random, the questions that I have, so I don't know where, So if you feel like we didn't cover that, just skip the question, all right? And you'll be good to go. All right, guys, go have a good evening. And again, stay in touch. If you need anything, just shoot me an email. I get them all the time. Text me, whatever. I'm here to help, okay? Everyone's going to do
When are
fine.
you opening the midterm? What date?
Not in the
time?
morning, Tuesday morning.
Ben, do we
Okay.
need any specific software before we take the test?
No, there's nothing. Just go study. Remember we put that spreadsheet up on the taxes? Where's the, hold on. Let me just go to my desktop. One sec. Um, I give you a sample asset sheet just to look at. You may need, just may need to do something like this on a notepad while you're doing your test to keep track and figure out what's in the probate estate and what's in the gross estate on on a couple of questions. But again, you said slide module 1, 2, and 3, and you'll be all good to go. Okay, but there's no software or anything that you need, not at all.
Throw in any questions that might be good that for us to review.
Yeah, right. You want some special questions, Fedra? Just on your test, okay? Just on yours. I will do my best. I will not. I'm not looking to hurt anybody. I really don't. I'm not my son's calculus 3 teacher. I promise. Okay. So, I'm not going to give you any, you're not going to have to do any algorithms or anything like that. So, yeah, don't worry about it. Just study these 3 slide decks, study the chapters, and everyone's going to be fine. And I'm going to go post a study guide somewhere right around here. Some tests, actually, just be questions, but I'll give you the answers, okay? All right, guys?
Great.
Well, if you do a review on Monday, I'm in.
Just everyone who wants an hour on Monday, just shoot me an email if you want extra help. Okay? Shoot me an email and then I'll schedule it. All right? Then I'll have everyone who wanted to participate and I'll email you back.
Fantastic.